Welcome to the Coin Bureau Weekly Crypto Review. Here are this week's top headlines in the crypto news. NFT frenzy. Visa and Budweiser show off their newly purchased NFTs, and Facebook's digital currency wallet reveals its plans to support NFTs. But why and what are they planning? Stablecoins protecting their groins. Paxos and Circle pivot ahead of possible regulations, while Tether begins printing USDT for the first time in weeks. Is there cause for concern? Bitcoin hash rate back on the rise, the bullish indicator that no one is talking about, and how it could be setting the stage for new all-time highs. Bitcoin futures ETFs ready and set. Go will be in October, according to Bloomberg analysts, but impatient institutions are already buying Grayscale's GBTC. So, what does this mean for BTC? Infrastructure bill gets a date, and the wording is less than great. Here are a few things you should do with your crypto before it's too late. Cuba adopts cryptocurrency. The island nation's central bank has announced that crypto payments will be recognized and regulated. What we know so far. The Cardano Foundation's concerning partnership. All ADA and native asset transactions will soon be closely tracked in the name of compliance. The pros and cons of this controversial move. And a closer look at the cause of last week's crash in this week's crypto market forecast. All this and more in just a moment. Good morning, afternoon, or evening. Thank you for tuning in. My name is Guy, and what you're about to see is educational content, not financial advice. You can find any topics you're looking for using the timestamps in the video timeline. And now for today's top stories. Last week, Visa revealed that it had purchased a CryptoPunk NFT for $150,000 in ETH. Visa's crypto department head, Kai Sheffield, explained that their reasons for buying the CryptoPunk were, quote, to help our clients and partners understand the infrastructure requirements for a global brand to purchase, store, and leverage an NFT. That's one expensive show and tell if you ask me, but it has set the scene for future NFT investments and NFT use cases which Visa is looking to pursue on Ethereum. If you're wondering why CryptoPunks are so valuable, it's basically because they were some of the first NFTs to be minted on the Ethereum blockchain. The unique value proposition of other NFTs is not as clear, and this seems to be the case with the beer rocket ship NFT Budweiser purchased for $25,000 in ETH on OpenSea. This NFT is now Budweiser's profile picture on Twitter, and it's possible that its future decentralized website will be built on the beer.eth domain, which Budweiser also purchased for $96,000 in ETH. In an interview with CoinDesk, a spokesperson for Budweiser's parent company said they were looking to build an NFT marketplace with the help of serial hustler Gary Vaynerchuk. I take this as a sign that we should expect to see more NFT shenanigans from Budweiser going forward, which will inspire more entertaining headlines like this one. Facebook was another big name which stuck its head into the NFT game last week, specifically Facebook's Novi cryptocurrency wallet, which was originally designed for Facebook's Diem aka Libra cryptocurrency. Those of you who watch my video about Facebook's crypto project will know that it's not all it was cut out to be, and Facebook's Novi wallet has been, quote, ready to launch for over 2 years now. Last I checked, Facebook's Diem was looking to participate in a digital dollar pilot in the United States back in April, and I have a feeling they've noticed that they're not the only ones on the CBDC block. Stablecoin issuers like Circle and Paxos seem to be positioning themselves to be the Federal Reserve's CBDC protocols, but their growth has raised the eyebrows of many regulators. Circle has been the fastest growing of the two, and it revealed the assets backing its USDC stablecoin in July this year. Not surprisingly, a substantial portion of USDC was not backed by dollars, but by corporate and government bonds, aka debt. This prompted Coinbase to change the wording on its website, which promised that USDC was backed by dollars shortly afterwards. But this is significant because Coinbase and Circle form the Center Consortium, which governs USDC, begging the question of why this wording had not been changed sooner. In what might be a response to the criticism that followed, Circle recently announced that starting from September, USDC will be 100% backed by cash and short-term US treasuries, aka government debt. This is eerily similar to the setup which regulators pressured Facebook's Libra to adopt, specifically that all the fiat used to purchase Libra's digital currencies would be invested into government debt. Nothing to see here, I assure you. Anyways, those of you who watch my video about the assets backing popular stablecoins will remember that Paxos posted a breakdown of its own reserves one day after Circle did. This time around, Paxos announced that it will be rebranding its Pax stablecoin to USDP to underscore the fact that Paxos stablecoins are backed entirely by cash and cash equivalents. While Paxos and Circle were duking it out, Tether decided to do its thing by printing billions of USDT for the first time in weeks, while remaining silent about its promises to audit the assets backing the 65 billion USDT in circulation. Some are interpreting Tether's USDT printing as good news for the crypto market, but I have a feeling that all it's going to do is draw the ire of US regulators like the SEC, which has already set its sniper scope on stablecoins. Now, you can learn more about all that using the link up there in the top right. Another thing that's been on the rise in the last few weeks is Bitcoin's hash rate, which has tripled since the end of June. For those unfamiliar, Bitcoin's hash rate is basically all the computing power connected to the Bitcoin blockchain. For the sake of simplicity, the higher the hash rate, the more computers there are mining Bitcoin. The reason why Bitcoin's hash rate took such a massive nosedive in May was because of China's de facto cryptocurrency mining ban. I covered this topic in much greater detail in a video I did at the time, and feel free to watch that after this by hitting that link in the top right. In that video, I predicted that we would see a strong shift of these miners away from China to other countries. Well, that appears to have happened, and the recent uptick in hash rate suggests they've finished setting up shop in new regions. Historically, Bitcoin's hash rate has correlated quite closely with its price. The fact that Bitcoin's hash rate continues to rise, even as prices fall, suggests that there are still more gains on the horizon for BTC. The relatively low hash rate we continue to see has also contributed to the profits of crypto mining companies elsewhere around the world, which reported record numbers last quarter and are likely to see similar numbers this quarter. As I mentioned in last week's crypto review, many institutions are getting indirect exposure to crypto from investing in crypto mining company stock, and this impressive growth could attract more dollars to actual coins and tokens from institutions. The things that institutions are really waiting for from crypto, however, are cryptocurrency ETFs. If you've watched my video all about that topic, you'll remember that ETFs are basically like stocks which mirror the price of the assets they represent. ETFs are well regulated and are therefore preferred by legacy investors. Most ETFs are backed by the actual asset, and this means that the ETF issuer buys and sells that asset in the background based on the demand for that ETF. This is how most of the Canadian crypto ETFs work, but it's not how any upcoming US crypto ETFs will look like. That's because the US crypto ETFs will most likely be backed by futures, aka paper, aka numbers floating around in some computer somewhere. This is a suboptimal outcome, and I've explained why this is so in my recent video on futures ETFs, top right, as if you didn't already know. This lack of crypto exposure is probably why Morgan Stanley decided to YOLO $240 million into Grayscale's GBTC trust. This makes Morgan Stanley the second largest holder of GBTC, the first being ARK Invest with nearly $350 million invested in GBTC. Grayscale's crypto trusts have been a popular alternative to ETFs for institutions looking to get exposure to coins and tokens. But the problem is that they don't track the price nearly as perfectly as ETFs for reasons I won't get into here. Even though futures ETFs won't offer direct exposure to the crypto in question, an announcement of some kind of ETF, be it for Bitcoin or Ethereum, would do wonders for BTC and/or ETH, and Bloomberg analysts believe we could see many of them approved in October. Now, I happen to believe that we will see these ETFs go live in mid to late September, which might be where the current bull market will peak. I covered this in greater detail in my recent market analysis vid, which I'll leave in the description for you folks. As I mentioned in the video I just referenced, part of the reason why I believe the crypto market will start to crash at the end of September has to do with the infrastructure bill that could be passed around that time. Now, I know I've been talking a lot about the infrastructure bill lately, but it's really something that could mess up the cryptocurrency market for a very long time. This is again because of that damn crypto tax clause, which requires all so-called brokers to collect KYC from users for tax purposes. Though regulators have promised to be gentle with how they apply this definition, I am not one to trust regulators, much less the politicians who slip unrelated stuff like this crypto clause into infrastructure bills. Right now, the tentative date for the infrastructure bill to pass is September 27th. After that, it just needs to be signed by the president and it will become law. And then the wolves will hop into the sheep pen. In terms of what you should do with your crypto around that time, the most important thing is that you make sure you're keeping it all in your own non-custodial cryptocurrency wallet. If you don't have one of those, don't know a wallet that supports your favorite cryptos, or don't know what I'm talking about, I recently made a video that can help, and you can find that in the description. Now, while I can't give you any financial advice, I can tell you that I'll personally be keeping my gains away from centralized stablecoins when the bell tolls in late September. That's because Circle, Paxos, and Tether have all frozen tokens before, and if regulators come out and demand they do so, they won't hesitate to comply. Though there are some robust decentralized stablecoins like Terra's UST, it's possible they too could find themselves being swept up in the storm. Also, make sure you've completed KYC on a cryptocurrency exchange you trust that supports all the cryptocurrencies you hold. Exchanges will certainly be front and center for regulators, and the last thing you want is to be locked out of your account or find yourself in a position where you're unable to sell your coins or tokens. I also happen to have a video about the top 5 regulated cryptocurrency exchanges, and you can find it up there in the usual spot, top right if you forgot. Between now and the end of September, however, we're likely to see a lot of announcements that will be insanely bullish for the crypto market. One of these is going to be Cuba's adoption of cryptocurrency payments, which its central bank has announced it will be sanctioning in the weeks ahead. Now, the details about what exactly Cuba is planning with crypto payments is still up in the air, but its central bank specified that citizens will be allowed to use crypto payments for, quote, reasons of socio-economic interest. This obviously excludes any illegal activities, and Cuban regulators will be keeping a close eye on any individuals or institutions using cryptocurrencies to make sure they're not up to any funny business. To me, Cuba's move sounds awfully close to making cryptocurrency legal tender, and if true, then it would make Cuba the second country to make cryptocurrency legal tender, the first obviously being El Salvador. Cuba's motivation for embracing cryptocurrency payments is not all that different from El Salvador's, namely a reliance on the US dollar and economic issues relating to US sanctions. Cuban citizens have already actively been using cryptocurrencies since 2019 to bypass various economic sanctions, so it's logical that the Cuban government would seek to bring cryptocurrencies under its wing. The only problem is that this could cause a stir among global regulators in the United States and elsewhere who very much want to see those sanctions respected for whatever reason. This could potentially lead to a crackdown on peer-to-peer cryptocurrency transactions. On that note, last week the Cardano Foundation penned a partnership with CoinFirm to, quote, be in full compliance with the FATF's Financial Action Task Force guidelines, 6 AMLD and other supranational and national regulations. If you're wondering why this partnership is a cause for concern, you probably haven't watched my video about what the FATF has planned for cryptocurrencies come October 2021. In short, the FATF is going to push for every single individual and institution using cryptocurrency to complete KYC, aka papers, please. Right now, nobody really knows just how far-reaching the FATF's guidelines will be because they're set to issue their final recommendations in October, hence the deadline I just mentioned. In a worst-case scenario, Cardano holders could find themselves in a position where they're locked out of their wallets until they complete KYC, and this seems to be the FATF's ultimate endgame for all cryptocurrencies. Now, I can certainly understand wanting to protect users and prevent people from doing bad things, but as someone who personally holds a significant amount of ADA, KYC is the last thing I want to see when I log into Daedalus. To be clear, I'm not saying that it will get to that point, and for the time being, it looks like Cardano is just using CoinFirm in the same way that many other cryptocurrencies use blockchain tracking tools like Chainalysis to track obviously illicit activity. The good news about this partnership is that compliance will make institutions more comfortable with investing in ADA, and as long as this compliance doesn't violate the values of cryptocurrency, I'm all for it. In other Cardano news, this week we should find out whether Cardano's smart contract testnet hard fork was successful, so be sure to keep an eye out for that. If you're not up to speed with what Cardano has been up to, you can watch my most recent video about the project using the link in the top right. Turning to the crypto market, I'm sure you all felt that dip late last week, and you might be wondering what caused it. Well, it looks like it was a combination of factors, the main one being the billions of dollars of BTC options which expire on the last Friday of every month. Without getting too technical, an option gives you the right but not the obligation to buy or sell an asset at a predetermined price at a later point in time. A call option is the right to buy an asset at a predetermined price later on, whereas a put option is the right to sell an asset at a predetermined price later on. The former is bullish and the latter is bearish. Now, more often than not, big investors who are bearish on Bitcoin and have lots of put options will push the price of BTC down as much as they can at the end of each month to maximize profits, or so the story goes. This is sometimes termed banging the close. Many believe this is why BTC tends to dip at the end of each month and tends to peak in the middle of the month. Options expiries weren't the only thing making the markets wonky, though. The fact that politicians voted to reject any further amendments to the infrastructure bill put a dent in the crypto market too. Then there was the Jackson Hole Symposium, which is where central bankers get together to talk about money printing. Lots of investors were worried about what the Fed would say about tapering, aka reducing the amount of government bonds it's buying, aka the amount of money it's printing. There are, of course, other world events that have markets on edge, which I won't discuss here. Now, as I'm filming this week's crypto news review a bit earlier than usual, this weekly winners list is going to be a bit different. Rather than show you the ones which have gained the most in the last week and where they might be headed next, I'm going to pick a handful of cryptos that look like they're about to pump. My first pick here is Polkadot, and this is for two reasons. First, DOT is one of the only large-cap cryptocurrencies that hasn't pumped yet. And second, Polkadot should be announcing its parachain slot auctions any day now, and if that announcement comes this week, DOT will likely move up a few percentage points in response. My second pick is Avalanche, and this is primarily because of its massive DeFi incentive program titled Avalanche Rush, which has so far attracted Arewave, Curve Finance, and more recently, SushiSwap. I have a feeling that we're going to see more high-profile DeFi deployments on Avalanche in the next few weeks, and once they go live, this could easily take AVAX to new all-time highs. My third pick is Cardano, and that's because ADA could rise on the news of a successful smart contract testnet hard fork, which is scheduled for September the 1st. Even without this announcement, ADA is looking bullish as hell on the price charts, and I reckon it's going to keep pumping until smart contracts go live, and probably well beyond that. My fourth pick is Solana, and that's because it's starting to see some serious retail and institutional adoption. Sol's price chart is also printing a pattern which I will refer to simply as the topless letter P. This is basically when the price pumps, retraces a bit, and pumps again to where the previous pump ended. This topless letter P is an integral part of many bullish price patterns in technical analysis, and it's one that I've successfully traded in recent weeks as well. I'll leave a few videos to my technical analysis tutorials in the description if you're interested. My final pick is Arewave, and that's because Arewave stores all of Solana's blockchain data. The greater the demand for Sol, the greater the demand for the AR coin, which is why their price action is almost identical. Now, if you want to learn more about Arewave, I recently did a deep dive into the project, which you can also find in the video description. That's all for today's Coin Bureau Weekly Crypto Review. If you enjoyed it, you know what to do. hit that like button, subscribe button, and bell icon too. If you want more of me, head on over to Twitter, TikTok, Instagram, and my new Coin Bureau Clips channel to get a sneak peek behind the scenes. If you join my Telegram channel, you'll get the daily crypto updates you crave, and signing up for my weekly newsletter is a great way to get the tools, tips, and tricks you need to get paid. And of course, you can support the channel by heading over to the Coin Bureau merch store and picking up a shirt or hoodie or both. Links to all these resources are in the description. Thank you so much for watching, and I'll see you all in next week's episode.